Hello, YouTube. We start the week off red on the SP 500, down by about 1.6%, and the NASDAQ down by about 1.5%. What is so important for today is that we are resting right here on a critical uptrend. So if we're going to continue our grind higher, if we're going to get over our 200 DMA, we cannot really afford to stall out here. So if this time is different and we're going to actually break higher, there's something really important I'm going to be paying attention to here. And we had some Fed speakers today as well. So we're going to go over all of that. But if you wouldn't mind, as we're getting started, it would mean a big personal favor to me, Justin. If you could please smash a thumbs up, click the thumbs up, just do whatever it takes. Click on it, please, and thank you. All right. So as we look here to our current uptrend, this is important because we have a drop off in volume and we have consolidation, which means we're not really making a huge move here. So if this time's different, meaning we're going to actually rally, and this is the real rally, like it was not in March, like it was not in June, but as of right now, in October, it is currently holding. We cannot afford to stall out. And I say that because we have a key area we're looking at here. It's the high from our CPI report. It's at 395.04. What is our low of the day? 395.11. That is a save by 7 cents. Keyword being cents, not dollars, but cents. So if we've now back tested the area that we have here for our pump going into the CPI, and we have a recipe here for squeezing bears, meaning CFTC equity fund managers raise their S&P 500 net long position to 90,000 contracts. Speculators are short. Who's usually right? The smart money. So fund managers are usually right. If the third time's the charm, we have to go higher from here. Got to get that Santa rally. So really important, but also because there's greed. And right now, I think there's greed with the bears and the bulls. So if we're going to climb the wall of worry and then finally get over it, meaning over the 200 DMA, we need to start moving higher from here. If not, the risk, and notably with what the Fed has told us today, is that we might be coming down not just to 390, but even lower. Why? Well, this is a really bullish pattern here. We have an inverse head and shoulders with our neck being at roughly 390. And this is like super simple for me. We're really just dancing around these gap zones over here. So red line means resistance. That was last week's high, roughly 401.44. Then we get 395.78, call it 396, and then 390. So if we can't hold 396, which we did into the close, barely, actually on market on close at 395.91. So not quite there, but I would call that close enough. We're probably going to start going lower. Probably back down to 390. So this last uptrend here is like really important because what I heard from the Fed today tells me it's like time to be mindful of the downside. Bullard, markets underpricing risk. FOMC may be more aggressive. What are they saying? They're basically saying, so let's just read the other comment here. On pace of hikes, I defer to Chair Powell. Doesn't matter that much in macro terms, how quickly we get to the right level. So the question is he going to blink? Is he going to blink? Is he going to blink? Is Jerome going to blink? So we have Bullard out there who is the bulldog, right? The hawk out there saying, we got to do this. The market is underpricing the risk. And he's also telling us that might go lower, but for longer, meaning we're going to hold interest rates higher. And he's telling us whether or not Jerome has optionality. We'll let Jerome speak for himself, which is what James Bullard also said. But when we look here to the next comment, Fed may have to keep rates higher through 23 and 24. As of right now, the market is pricing in cuts into 2023. What does that mean? There is a disconnect between what the Fed is telling us and what the market is pricing in. So if we're not fighting the Fed, today should be the start of the downside. This should not be the end. It should be the start. And I heard a lot of comments. We're not going to go through every single one today just to keep the video a little bit shorter. Fed Williams, who was in the Troika, or the third most important person at the Fed. He is the president of the New York Fed. So Fed could lower rates in 2024. Man, that's like a year longer than the market's pricing in right now at 2023. And this is the big dove, right? This guy's really dovish. So that means he's supportive of stocks. Fed could, not will, could lower rates in 2024. He also tells us that says inflation fight could last into 2024. Yay! And then there was one more thing I heard. It was that we need to see 2023 actually seeing deflation. And what they mean by that is not only do we want to see a peak in inflation, we want to actually see negative prints. And because we have data coming out this week, notably PCE coming in pre-market on Thursday at 0.3. This is still trending down, but this is the print for October. So we got November, then December, then 2023. What they're telling us is that unless we see these numbers start going negative, not just flatlining. If you look here, right? Well, we don't have a negative print going back to 2020. We got a negative, plus 0.1, plus 0.5, and now we're looking for 0.3. But they're basically telling us that this is like showing us peak inflation is there. I believe how I am reading this is that we're probably going to have to hold interest rates higher, between 5, maybe 6%, unless we start to see inflation actually come down. It can't just be flatlining. It has to actually have those negative prints. We have not yet had one since 2020. That's like really important. Also saw BlockFi listing for bankruptcy protection today, $1 to $10 billion in assets and liabilities. And this is a really big week. We got Jerome Powell speaking on Wednesday. We got lots of data. CPI coming out on Wednesday. Consumer confidence tomorrow at 10 a.m. I went through a lot of this on the weekend, so encourage you to watch that one, which is pinned and also in the comments if you want to read it. Let's just go through a couple more charts, then we're going to wrap it up here. So we already know the significance here on SPY. However, if we now look over here to ES, which it accounts for pre-market trading, which is when the CPI report comes out, it's pre-market at 8:30. Our high from the candle right now, 39.73.50. Where are we resting right now? Well, 39.72. We poke below. There's no gap here on the chart. It's about 75 cents. No big deal. So we got decreasing price, but we're now falling below our primary downtrend. So remember, S&P and ES are going to have different trend lines just because one trades continuously, which gives us clean touches. Clean, 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 clean. And if we lose this area, it means the bears are starting to reclaim control. Why? I just showed you net speculators have increased their long position. So if they've increased their long position and they're not willing to defend it here, maybe what's happening in China is starting to weigh on them. And maybe we have to start going down. That's like really important to me. Next thing I would look at is just going to be QQQ on the daily chart. So when we look here to QQQ on the daily chart, well, we're like already starting to stop go up. So we can now revise this trend line to give it our absolute trend. And now we note that, so we stopped going down, but maybe now we're going to stop going up. Why? Well, if we lose our uptrend or we just go sideways for 1 or 2 more days, we lose the uptrend. We stop going up, which means we're going sideways. We're going sideways below the 200 of May, but over the 50. So who wins? I don't know. I don't know who's going to win. I said that on the weekend, but I said it's probably time to start looking to sell the rep. Also notice that we're getting a huge decrease in volume. So the way to think about sideways price action with decreased volume, it's like a spring. The spring gets really, 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 really tight, and then boom, it'll suddenly explode, either to the upside or it'll coil up, and boom, explode to the downside. That's what we're currently setting up. We're setting up the coil. Which way is it going to release? I don't know. I don't know. I think it's going to be down, but it might be another week of up before we ultimately go down. And what we can note when we look across here is that the dollar's up. Based on what happened in China, we're noticing it bounced off the 200 DMA, and it's looking constructive here. We have to get above 107.50, basically 108 to start clearing these relative highs. But looks like it might want to bounce. And the VIX is up by 9% today. Gap and go, baby. Whoop. And we talked about this on the weekend. Every time we got to roughly 20 on the VIX, that signaled the top on the market. So is this time different? Well, everyone seems to think so. Everyone seems to think the third time's a charm. So let them keep buying. Let them get greedy. And then what? Right? Punch these bears in the face. That's what's probably going to happen, right? Williams, who's a big dove, pretty much warned you. So did Bullard, right? Be careful. Be careful. That's what's really important here. One thing I would note is that Bitcoin and Ether are actually holding up relatively well, only down by about 1% and about 1.8, even on the news of more contagion with BlockFi. So inverse head and shoulder pattern setting up here. Let's see if it can hold. And then we look at Apple, which is really the focal point of all of the drama over the weekend, as that IHS as well. So all risk assets are like trying to find support, but it just lost the 50 MA as well, short-term price. Which one's going to be more important? The pattern, the chart, the price, the moving averages? I don't know. Sentiment's also really important. Tesla actually closed green. A lot of those same fears in Tesla, and we noted that $2 billion short that was put on late last week. So all I want to do now is just look at the weekly charts and just point out that we now have an inside bar. So when I say the coil is getting tight, and is about to explode, the explosion would happen by either getting to a weekly higher high or by getting to a weekly lower low, which means we're going to break the consolidation. That's what's really important for me. We look here to QQQ, and we note that same thing. We now have an inside bar, but last week we actually formed lower high and lower low. So this is like leaning bearish because we're still above our high from CPI. However, the one glimmer of hope for the tech bulls is just that it's down by about 0.1% less than the S&P today, only down by about 1.47. S&P is down by 1.6. So even with Apple weighing, tech is actually still holding up better than the broader market. We're going to ask you, please and thank you one more time. If you're still watching, to please smash a thumbs up. And if not, we do have a Black Friday sale on right now. So if you're watching all the way till the end of the video, congratulations, you might get the cheat codes here. Because after we finish the YouTube video, the work is not done. And if you want to come trade with me, Justin from YouTube, you can click on the link in the description or go to thealgo.com. We have a Black Friday sale on right now for up to 50% off compared to our monthly pricing. And that sale is going to end in 4 days. So if you want to come trade with me, I encourage you to do that. If you want to join on our standard plan, just click on the link and you will find that as well. If not, watch the weekend deep dive, which will be in the top pinned comment and also in the description. If not, I very much look forward to seeing you tomorrow, and I wish you all the best of luck. Thanks so much.